Stop trying to track every single penny in a spreadsheet you know you'll abandon in 2 weeks. Stop drowning in financial jargon like PE ratios and asset allocation that just makes you feel more confused. It's easy to get the sense that you have to track hundreds of different financial metrics, but the truth is, most of them just don't matter for the average person. The financial world can feel overly complicated, but building real wealth is simpler than you'd think. What if I told you that everything you need to know to build a powerful financial plan and finally feel in control comes down to just 3 numbers? These are the only 3 numbers you'll ever need to focus on, and by the end of this video, you'll have a clear, simple system to master them. This isn't about restriction, it's about clarity. And it's a whole lot easier than you've been led to believe. The old way versus the new way. For years, we've been sold the 50-30-20 rule. 50% of your income to needs, 30% to wants, and 20% to savings. It sounds like a neat little package, right? But for so many people, it just doesn't fit. For some, essential costs in expensive areas blow way past 50%, making the rule feel impossible. For others who are high earners, it can feel inefficient, almost encouraging you to spend more just to fill the buckets. This old way can force you to micromanage every dollar. It makes you feel guilty for buying a coffee because you're not sure if it's a need or a want. You spend hours categorizing transactions in some budgeting app, only to get frustrated and quit a month later. That approach obsesses over the symptoms, the individual purchases, instead of the big picture. The new way is about a total shift in perspective. Forget tracking every transaction. Forget the guilt. We're going to focus on 3 high-level numbers that give you a complete and accurate snapshot of your financial health. This isn't about building a rigid, restrictive budget. It's about creating freedom through clarity, so you know you're on the right track and can spend the rest of your money without a second thought. Section 1. The first number, your freedom income. The first and most fundamental number you need to know is your monthly net income. This is your take-home pay, the actual cash that lands in your bank account each month after all taxes and deductions are taken out. I call this your freedom income because this is the money you actually have the freedom to work with. So many of us make the mistake of planning our lives around our gross salary. We draw up a budget based on $80,000 a year but are constantly wondering why the math feels off. It's because you never actually see that full $80,000. After taxes, healthcare, and other deductions, the number is way smaller. Knowing your freedom income is the bedrock of any realistic financial plan. So how do you find it? This part's easy. If you have a regular salary, just look at your last few pay stubs or the direct deposits in your bank account. Add up what you received for the month and that's your number. If you're a freelancer or have a variable income, there's just one extra step. Look back at the last 6 to 12 months of your income. Find your lowest month. A safe, conservative approach is to build your monthly plan around that lowest number. This way, you know your bases are covered even when things are slow. For years, I made the mistake of using my gross salary for my budget. I felt rich on paper but was broke in reality. The moment I shifted my focus to my actual take-home pay, my freedom income, was when the fog finally cleared. It's a simple shift, but it's profound. It's the first step to grounding your financial plan in the real world. Section 2. The second number, your future-proofing rate. Okay, so you know what's coming in. The second number tells you how fast you're building your future. But we're not going to do it by tracking every expense. Instead, we're going to focus on your savings rate. Your savings rate is the percentage of your income that you save and invest, and it is arguably the single most important number for reaching your financial goals. Why is it so powerful? Because it's your speedometer on the road to financial independence. It doesn't matter as much how much you make. What matters is how much you keep. Someone earning $50,000 a year with a 30% savings rate is building wealth much faster than someone earning $150,000 with a 5% savings rate. Your savings rate automatically bakes your income and spending into one powerful metric. When you focus on this number, the small stuff, like that daily coffee, becomes almost irrelevant. Now, to calculate this correctly, we need to look at your gross pay for a second. That's your income before taxes. We use gross pay because it accounts for pre-tax savings, like your 401k contributions. Here's the formula. Take the total amount you saved and invested in a month. This includes your 401k contributions, any employer match, IRA contributions, and cash you moved to savings, and divide it by your gross monthly income. Then multiply by 100 to get a percentage. Total monthly savings, gross monthly income, x 100 equals sign your savings rate. For example, if your gross pay is $6,000 a month and your take-home freedom income is $4,500, and you contribute $600 to your 401k and move $300 to a savings account, your total savings are $900. Your savings rate is $900 divided by your $6,000 gross income, which is 0.15, or 15%. A great starting goal for most people is a rate of 15% to 20%. The magic here is that it reframes your entire relationship with money. Instead of stressing over every purchase, you focus on hitting your savings goal first. Once you've automated that 15% or 20% into your savings and investments, you have full permission to spend the rest of your freedom income however you want, guilt-free. This is the pay yourself first method, and it's the key to staying consistent. Section 3, the third number, your financial scorecard. So we have the money coming in, our freedom income. We have the speed at which we're building wealth, our future-proofing rate. The third and final number is our financial scorecard. It's the one number that shows the cumulative result of every single financial decision you've ever made. That number is your net worth. Your net worth is simply what you own minus what you owe. Think of it as your personal balance sheet. While income shows what you earn, net worth shows what you've built. The wealthy focus on growing their assets, not just their income, and that's the mindset shift we all need to make. Calculating it is straightforward. First, add up all your assets, cash in your bank accounts, the value of your investment and retirement accounts, the current market value of your home, the resale value of your car, and anything else valuable you own. Next, add up all your liabilities. These are your debts, your mortgage, student loans, car loans, and any outstanding credit card balances. The formula is dead simple. Assets. Liabilities equals sign net worth. For a lot of people, especially early in their careers, this number might be negative. That is completely okay. Seriously. If you have student loans, it's almost expected to be negative at first. Don't let that discourage you. Your starting number doesn't matter. What matters is the direction it's heading. The goal is to track this number once or twice a year and just make sure it's going up. Tracking your net worth changes how you see your decisions. Suddenly, taking on a new car loan isn't just a monthly payment, it's a direct hit to your scorecard. On the flip side, every time you invest or pay down a chunk of debt, you see your net worth climb. It's the most motivating game you can play with your money. Synthesis, how the three numbers work together. These three numbers aren't just separate stats. They work together to give you a complete picture. Your freedom income is your resource, the money you have to work with each month. Your future-proofing rate is the dial you turn to decide how much of that resource goes toward building your future. And your net worth is the scoreboard. It's the tangible result of your efforts over time. They create a feedback loop. When you see your net worth, you're motivated to find ways to increase your savings rate. To increase your savings rate, you get smart about how you use your freedom income. It all works together, creating momentum that builds on itself. Conclusion and CTA. So let's bring it all home. You can forget the hundreds of complicated metrics. Real financial control comes down to knowing and tracking just three things: your freedom income, what you actually take home; your future-proofing rate, the percentage of your gross income you save; your financial scorecard, your net worth. That's it. Master these three numbers and you master your money. Financial control isn't about pinching pennies. It's about having the clarity and confidence to live your life. If this video helped clear things up for you, hit that subscribe button. We're all about making money simple here. And for your next step, check out this video right here on the first 5 things you should do once you've saved your first $1,000. Thanks for watching.